big storm on the West Coast. The biggest storm ever made on the Pacific Coast. Did you see that? I didn't know it. What's that? Yeah, it's the biggest one ever, they think. 200-mile-an-hour winds they think are going to hit Mexico. Oh, wow. Yeah, a tourist area could get wiped out. A whole bunch of poor people who live all around the tourist area. So, yeah, it's interesting. So, they're already, they're boarding up all the windows and stuff, which you don't ordinarily do, but they're also apparently starting to evacuate people in anticipation of this monster. So, who knows what it's going to do. Nobody's ever seen anything like it. Yeah, there's no global warming for you guys. No global warming. Maybe not. Maybe it's just God's out to get us now or something. You know, it could be. Yeah. Hope not. Okay. So, equity. You guys do know about this, don't you? Assets equal liabilities plus equity. You know what equity is. Okay, and equity consists of what? Oh, no, we have this stuff. Which, by the way, goes into equity, doesn't it? Net income or net loss is part of equity. So anyway, equity consists of what? Contributed capital, which is going to be common stock and preferred stock. Okay? There'll be a variety of contributed capital. All right? They all work exactly the same way. How do you increase them? With a credit. How do you reduce them? Debit. Unless they're a contra equity account, then what do you do? Increase it with a debit. Reduce it with a credit. Big deal. Okay? It's easy. And then the other major category? Retained earnings. And then in retained earnings, of course, you increase that with credits. That would be net income, right? Okay? When we start the company, beginning retained earnings is nothing. Over the years, we add up all their net incomes for all the years the company exists, right, guys? And we take away all the net losses, because the net losses would be debit. So everybody knows this, right? Expenses are more than the revenues. You get a net loss, which is a debit, don't you? Instead of net income. And the net losses up for all the years would be taken out of retained earnings. What else comes out of retained earnings over the life we have? All their dividends. This is it, okay? The world we live with. Now we're going to have both cash dividends and stock dividends. So we're going to add something there. Cash and stock dividends both, but they're both going to work the same way. They're a debit to retained earnings, okay? You reduce your retained earnings. And so we'll have the ending. So when you look at any company's balance sheet, they've been in business 100 years maybe, right? What are you looking at when you see their retained earnings? It's all the income they ever earned, less all the losses they ever had, less all the dividends they ever paid. That's it, okay? So it's useful information, kind of, right? Okay, that's what it is. There's one other category besides contributed capital and retained earnings, and we did this in Chapter 5 a little bit, but not much. Other comprehensive income, another category in there, right? Another one of those little white lies I did, right? You know, there's really 3 categories of equity. That other comprehensive income is where we put things that we don't know quite what to do with. We don't want to put them in net income. Sometimes they're negative, so we really don't want them in net income, right? Reduced income. So we put them in other comprehensive income. Here's an example of it, and we'll get into this more later. In a later chapter in the appendix, I mentioned the appendix to you guys, that it's investments in other companies. It's really important stuff. And that's where investment held in maturity bonds is. Okay, it's in there. But there's also investments in trading securities and investments in available for sale securities, short-term and long-term. The gains and losses. Oh, by the way, the available for sale securities, we want to show them at market value. If you have an investment in Papa John's, do you know what it's worth every day? Sure, you can look up what the stock's selling for every day, right? So when we do a balance sheet at the end of the year for all the publicly traded stocks, should we put them in our balance sheet at market value? Yeah, I think we should. And that's what generally accepted accounting principles are going to have us do, okay? So we're going to show them at market value on our balance sheet. Well, that makes sense. If they increased in value, you debit the investment, right? Available for sale securities, okay, short-term or long-term. If they decreased in value, you credit. The problem was we didn't know what to do with the other side of the journal entry. Logically, you'd say, well, shouldn't that go to retained earnings, right, through income? So a gain or a loss. Well, yeah, probably, except what if you're not going to sell the stock anytime soon? Is it a real gain or loss? That was the argument. Really what the deal is if people have big losses, they don't want those losses to hit their income statement, especially if they don't intend to sell the stock, right? Barry mentioned to you guys that my wife and I lost half of our wealth, right? Stock market was at about $18,000 Dow. Was it about 18? It went down to 6,500 or something. We lost more than half. It went down to about 1/3. Everybody panicked. You know what it was yesterday? 17. This is 7 years ago. Went down to this in 1 month, right? So also 7 years ago. This is now. So was it a real decline in value? Well, I don't know, right? I didn't sell anything, so not for me. What about for people who did sell? Yeah, I sold at the bottom end, right? You took a major hit, didn't you? If you're retired and you have to live off of it or something, it's kind of a mess, huh? Okay, it's a mess anyway, all right? But now it's back up, okay? Who knows? Maybe the next few days it'll get there, okay? I think it's 18,300. Okay? So what the companies did when this went down was the loss went into other comprehensive income. It did it on their income statement into retained earnings. Make sense? But the compromise is if there's gains, the same thing happens. It goes to other comprehensive income. So you always want to look at other comprehensive income and see how big that number is. If it's a huge loss, there's other things, unfunded pension liability, that sort of thing that goes in there. We'll talk about that stuff later too. Okay? All right, when we get to that appendix chapter. Okay, so what we're going to be doing, you guys, is contributive capital and a little bit of retained earnings for this chapter. It's not a very big deal. Okay? So one thing that happens is we issue stock. So how does stock work? What is this stock anyway? Common stock of a company is what? It represents the owner's investment in the company, right? Okay? If we buy somebody else's common stock, it's our investment, which is an asset. This common stock is what? Our equity, right? On our side, it's equity. On our investor's side, it's their asset. True? Okay? So we've got common stock and we have preferred stock. Two types of stock. We'll do mostly preferred stock next time. Okay, we'll handle that stuff next time. Okay, let's say it's just common stock though, and this is going to be the same for both of them anyway. We have something called authorized shares, something called issued shares. So these are shares, okay? Each share is a portion of ownership, right? There's 1,000 shares and you own one, you own 1/1,000th of the company. You got the idea? There's 1,000,000 shares and you own one, you own 1/1,000,000th of the company. Yeah, that's it. Okay. All right. Authorized, issued, and then there's something called outstanding. You need to get this idea down. Okay. So what authorized is you file articles of incorporation in the state that you want to be a corporation. Okay. You want to become a corporation in the state. By the way, unless you have a felony conviction, right? You've been convicted of stealing from other people, right? Okay. Unless you have a felony conviction, what do you think that the state will say? Any of our states, what do you think the states will say? If you say, I would like to open a business, employ a bunch of people, and generate a whole lot of economic activity. What are they going to say to you? Yes, of course. Thank you very much, right? Of course, we're trying to create jobs, right? Okay, so of course, if there's such a thing, we're trying to generate employment, right? Okay, generate economic activity, provide goods and services. So sure, tax base and all that. So they're going to say yes, okay? So all you do is you file articles of incorporation, and maybe we'd say we want to issue not 1,000,000 shares of stock, okay? And they'll give us permission, okay? So someday we want to issue those. But we always get authorized to issue a whole bunch more than we think we're going to issue, so that we don't have to file an amended articles of incorporation asking for the right to issue more. By the way, when you file your amended articles, you sold all your shares and now you want to grow. So you sold the whole million. You think they'll give you permission to issue a bunch more? Yeah, and this time they'll probably say 100 million or something, right? So that you won't run out of them for a long time. So let's say you did 1 million when you started, and we issue 100,000 of them to ourselves. We're setting up the business. Group of you sitting here, we put our money in together, right? We set up the business and we issue the 100,000 shares to all of us, okay? For whatever amount we contribute. We could contribute cash, land, building, equipment, all kinds of assets, right, guys? This is something, okay? So let's say we issue 100,000. What we'd say at this point is there's issued and outstanding 100,000 shares, okay? How many are unissued, you guys, if I asked you for that? A million less 100 is 900,000. Get these points, huh? Okay, very simple, very simple. Okay, now what's the difference between issued and outstanding? Well, the deal is you could buy your own stock back if you want. And what do we call that stuff? Those of you who read the chapter, what do we call that stuff? Treasury stock. That's it. Can we invest in our own stock? The answer is no. That would be ridiculous. You can't invest in yourself, right? But if we buy back some of our shares, we call that treasury stock. So if I bought back 10,000 of those shares, how many are outstanding, everybody? You know, you issued 100,000, bought back 10, how many are outstanding? 90,000. Got the idea of what those things are? It's not a big deal. Okay. All right. So what we do on our balance sheet is we would say how many shares are authorized, how many are issued, and how many are outstanding. Ta-da. And then we'll also list the amount that was paid for the treasury stock. On lots of balance sheets, it'll say 100,000 shares issued and outstanding or something. What does that mean? If issued and outstanding are exactly the same number, what does that mean? There's no treasury stock. Right? It's right there. Okay? So just being able to read the balance sheet, that's all we're talking about here, right? You're going to see this stuff. Okay? Now then the other thing we do is we establish, it depends on the state. Some states have par values, some states have stated values, and they work exactly the same way. And some are no par states. In no par states, guess what? You don't have a par state value. Okay, you don't have to mess with that. Okay? And usually what we do is we set the par value very low. Okay? So let's say the par value is $1 a share, and I'm not kidding, they'll set it that low. It has nothing to do with what the stock's worth, okay? So let's say we did set the stock value at $1. At the time we authorized them, we set the par value at $1. But then let's say we think, well, we think our stock really should sell for $10 a share. So we think the market value is $10. Okay? So when I sell the stock, I'm going to sell it, right, to my shareholders, right, getting proceeds from the shareholders, investment from the shareholders at $10. Okay? So let's make this really simple. Let's say we issue all 100,000 all at once. Let's issue all 100 of these all at once. Okay? Got the idea? Let's issue them. What would be the journal entry for issuing those 100? If we issue them for $10 a share, and it could be cash, equipment, land, building, anything, inventory, whatever they want to contribute for their stock. Let's say it's cash, okay? So it's $10 a share on 100,000 shares. How much is going to be contributed to the company by the original investors here? It's $1 million, right? What are they going to get? Debit cash. So this is issue the stock. This is unbelievably easy. Issue the stock $1 million. Okay, if it is a par or stated value statement, I should comment on that. What a par is you write the par value into your articles of incorporation. Tell the state we're going to have a par value of $1. And the state will say, great. And we want to issue 1 million shares. And the state will say, great. Got the idea? Okay? So that's a par. Stated value is in some states you don't have to do a par value, you can do a stated value. In a stated value state, you have a board of directors meeting, right? Shareholders, right? Board of directors meeting, and they vote and establish a stated value. The nice thing about this is you can change it whenever you feel like it, right? You just have another vote, change it to a different value. In a state where you have a par value, you have to file an amended articles of incorporation. But usually when you want to change it, you want to change the number of shares you have in it. You can do something called a stock split. And we'll do that next. Okay, after we do this issuance. Okay? Stock split is no big deal. There's not even a journal entry. Okay? All right. So I told you this chapter is easy. It really kind of is. Even if you haven't read it, pretty intuitive. But do read it. I get the points out of this thing. Understand it. Okay? And next time, bring any questions you have about stuff we haven't covered yet today. Okay? There's a bunch of stuff in there. I'll cover whatever you guys want. Okay? All right. Well, we have a review session too next time, Phil. Getting ready for the quiz. We have 2 hour or 2.5, whatever it turns out to be. My intermediate students, Wednesday, made me do from 2 to 4:30, and then we had class from 4:30 to 5:45. We didn't even turn this thing off. It's 3.5 hour video. Oh my gosh. We were valuing companies, weighted average cost of capital, capital asset price. Oh, I was beat. So as soon as you guys disappeared, I started doing that. And they never left. It was amazing. This crowd here. So our class with only 20 people in it or so. Debit cash and credit what? Common stock. That common stock account I need right now. Okay, credit common stock. How much would you credit common stock for? Be careful. It's 100,000 shares at what? The par value. Let's assume it's a par stated value. By the way, if it's a no par state, it'd be the whole million. That makes sense? You don't have a par value. Okay, it all go to common stock. But in this case, if you have a par stated value, it'd be $1 a share. That's 100,000. So you know what's the paid-in capital in excess of the par? That's what we're going to call this. Isn't that a clever name for the paid-in capital in excess of par? Calling it paid-in capital in excess of par, right? There's other names for it too, but that's pretty much standard. Okay. So additional paid-in capital or paid-in capital in excess of par on common stock. It's $9 a share, isn't it? You sold it for $10. It's $1 par. It's $9, right? There's 100,000 shares. How much is that? 900,000. Everybody's getting these points, right? Aren't you glad you came today? Everybody's getting those, right? Big deal. Could that be land, building, equipment instead of cash? Sure, who cares? Okay, whatever it is. Yes.
What's it say for common stock for the 900?
Additional paid-in capital. APIC. Additional paid-in capital on common stock. Okay, good. You know, it's kind of nice at this point in the semester, always, but you guys, both of you classes this semester seems to be even more so. I can talk really fast now. I can use abbreviations now. I mean, you didn't know what the abbreviation was because they said it so fast? He asked. Isn't that cool? So do this when you go to work. People are going to want to go quickly, right? Time is really valuable. Besides, what would you rather do? Sit at work and do things very slowly and methodically? Or get your work done really fast, get your money, and go have a beer or something? Or go home and be with your family? Or go, be outdoors? What would you rather do? Work real slow at work and take a whole bunch of time during your living, or would you rather do it quickly? Which is going to generate, obviously, more wealth for the shareholders anyway, quickly and done well, right? And therefore for you, right? So you guys are really developing nicely. It's cool. It's great, right? You can keep up, can't you? And at the beginning of the semester, it was awful coming in here, huh? But still awful. But I mean, now you can keep up, though, right? And that's nice. That's good. Keep doing it. Keep doing it. Do it when you go to work. The other thing is, though, prepare for the meeting, guys. Half of you at least didn't read this chapter. Oh, come on, right? You know, the bad thing is, if there were only 5 of us here and I were your boss, you'd probably be more apt to have read the chapter, huh? Because I'd call you on it, wouldn't I? Here, there's less pressure for that. So it's easier to procrastinate and put it off. But you know what? When you go to work, your boss isn't going to be mean to you about it either. They're just going to stop inviting you to business meetings if you're not prepared. They'd have to be a really mean person, or maybe a nice person. If they says, you didn't bother to prepare for this meeting, why don't you go back to your office and do something you're ready to do, and then we'll see you the next one. I'd be the guy that did that to you, and they're humiliated, and upset, and they're worried they're going to get fired. But I think that's nicer than being nice and letting them sit through the meeting and do nothing, and then never invite them to another meeting. What do you think? Which is better? And that's what I think too. So I was never really nice to people and then fire them later. I think that's awful. Sit there and tell them what they were doing wrong. I don't like that very well, but usually you figure it out, right? Do it. Yeah. Anyway, kind of the approach I take in here with you guys, huh? Okay. Anyway, so here's where we're at. So that's issuing stock. Big deal. Let's do the stock split idea, seeing as we got this stuff up here and it's kind of easy to do it. No particular order here. That's a stock split. Okay, let's say that the market value is $10. Time goes by, and the stock market value increases to $100 a share. Now, this is a strange thing about investors. Could that happen, by the way, be 10 times as much? Yeah, a number of years go by, right? The company does really well. You sure? It'd be great. Okay? Might not even be that many years. Okay? It does really well. So now it's $100 a share. And what tends to happen is it's hard to sell the stock now. So if you own some shares and they're at $10, you can sell them easily. If they're at $100, it'd be harder to sell them. And this is just a psychological thing. People would like to own 1 million shares that are 10 cents a share instead of owning 10,000. What would that be? 1 million that are 10 cents a share is $100,000, right? Instead of owning 1,000 shares that are $100. Isn't that the same investment? Isn't $100,000 $100,000? Yeah, but there's something goes on in the market, right? Publicly traded companies, where the stock price gets very high, the trading slows down, right? Well, the reality is, if you never split stock, imagine if they never split, say, Microsoft. Shares would be selling for, I don't know, maybe $1 million a share. I don't know, right? If they never ever split them, so you have to split the stock anyway when it gets really, really high. Okay, certainly hundreds of thousands of shares they'd be selling for. The original people that had shares of stock, right, have a lot of wealth, billionaires. Okay, anyway, so what we do is we split them. So I'd file an amended articles of the corporation. I'd say, okay, I've got the $1 million that are authorized. I'd like to now have 10 million. What would that be? I'm doing a 10-for-1 split. So let's do a 10-to-1. 10-to-1 means there are 10 times as many shares now, right? I get back every share that's out there that anybody has for any reason, okay? And let's say right now I've got $1 million authorized, I got 100,000 issued, I got 90 outstanding, and let's say I have 10,000 treasury stock, right? Well, if outstanding is 90, treasury stock has to be 10, doesn't it? Okay, there's 100 issued. So I do a 10-to-1 split, everything changes, and here's the cool thing. No journal entry. Do not do a journal entry here, you don't need one, okay? So all I have to do is tell me, there's no journal entry. I'll give you a point for that or something probably. Okay, how many shares will there be now? All the authorized ones now, there's 10 for every single one there was. How many are there, guys? 10 million, I'm not kidding. This is a good thing to know, though, because you'll be going along, and all of a sudden there are 10 times as many shares or 5 times as many shares, and you're reading last year's financial statement and this year's financial statement, and things look really screwy, huh? Earnings per share really changes, right? There's 10 times as many shares, earnings per share is 1/10 as much. Got the idea? Market values change dramatically, too, when you do this, of course, right? Okay, so how many will be issued now? Every share that was issued, we give them each 10 shares for every single one of them. How many are there? 1 million. It's still 10%, right? 100,000 out of the million, now it's 1 million out of 10 million. Got it? How many are outstanding? 900. Why is that the case? Because treasury stock is how many? 10 times as many, 100,000. Everybody staying with me on this? It's not a big deal, okay? It's the difference between those two, okay? But what's going to happen to my par or stated value? I'm going to have to, when I ask to have 10 times as many shares, what I'm going to do to my par or stated value? I don't want to do a journal entry, everybody. So how much is the common stock account right now? 100,000, right? It's the issued shares, 100,000 times a buck, right? So what do I want it to be after this split? I'm not making a journal entry. It'll still be 100,000, don't I? You with me? You gotta stay the same. So, except now there's 1 million shares issued. So what do they have to be each? 10 cents. Got it. It's 1/10 this much. Sure it is. Okay? So we're still 100,000 in contributed capital, right? Or for common stock. Common stock. Okay. Everybody got the idea? What do you think will probably happen to the market value? Approximately what? Now there's other things going on in the market, so the price could be changing up or down anyway, right? Without doing the split. But if you do a split 10-to-1, their assets didn't change, their liabilities didn't change. Come on, what happened? Probably the stock is going to be worth what? 1/10 this month. It's going to be about 10 bucks. That's why we do it, to get that stock price to go down. Got it? So that's a stock split that's just nothing to this. But it's good to know what one is, huh? And like I said, what would happen to earnings per share if there's 10 times as many shares? 1/10 as much, huh? Or 5 times as many, it'd be 1/5 as much. The market price would adjust too. Okay? So that stuff's going on. All right, good. Well, let's see, what else should we do? You want to buy the treasury stock? Let's do that. Okay? Let's do the journal entry to record buying the treasury stock, and then maybe we'll sell some of the treasury stock. And let's go back to it being at $10 a share. So let's say I had this situation. My issued was 100,000 shares, right? 100,000 shares, not dollars. Okay, 100,000 shares were issued. Okay, and now I buy back some treasury stock, and I'm going to buy those 10,000 shares. Got the idea? And let's say at the date that I buy them, the market value is $10 a share. Is fine. Okay, I'm going to buy them for $10 a share. and I always buy them with cash. Now this is called the cost method, and just keep track of the shares at their cost. So if I'm buying 10,000 shares for $10 each, what's it going to be? Debit what? Credit what? Well, just do the credit, buying. What would it be if I'm buying 10,000 shares? What am I going to credit? Cash, absolutely. How much? $10 a share on 10,000 would be the $100,000. Would you guys agree with that? What would I debit for 100,000? Account named what? This is where I get my treasury stock, you guys. Treasury stock. And all you have to ask yourself is, what kind of an account is that thing? Can I invest in myself? No. So it's not an investment in myself. You're not going to put it as an asset. It's an investment in yourself. You're ridiculous. What is it? Contra equity and buying back some of my equity, right? I issued the stock and now I bought it back. So I leave the common stock and the additional paid-in capital the way it was, right, guys? I don't change those. But I'll have a debit balance in treasury stock. So imagine on a balance sheet, the equity section of the balance sheet, you'll see this in the chapter. The equity section of the balance sheet is going to be paid-in capital first. It's going to be common stock and additional paid-in capital on that, preferred stock and additional paid-in capital on that for a total paid-in capital. Then it'll show retained earnings, right? Okay, you add the retained earnings to the contributed capital, and obviously you've got equity, but then you subtract the treasury stock from that to get equity, right? Net equity. That's the idea. So treasury stock's the last thing listed in the equity section. If there is any, does there have to be treasury stock? Now, if you've got 100,000 shares outstanding, issued rather, and you have no treasury stock, you'd say 100,000 shares issued and outstanding. Got it? And usually when you look at a balance sheet, it's going to say issued and outstanding. What if outstanding is less than issued? What does that tell you? There's treasury stock. That's it. And you can tell how much there is, of course, because that's the difference. Got it? Okay? Lots of companies buy back their own stock for a variety of reasons. We'll get to that in a second. Okay, so there's buying it. Everybody got the idea? So I got that balance in that contra equity account. As soon as you know it's a contra equity account, you know you can increase it with a debit, reduce it with a credit. Right, guys? Now let's say that we sell, we bought it, and now we're going to sell it, okay? We're going to sell 4,000 shares, but in the interim, the market value went up to $11 a share. Oh, so it's $11 a share now, okay? Went up to $11 a share from that $10 a share. Got the idea? I have an economic gain on this when I sell it, but we can't have a gain or a loss on selling my own stock. It's just going to be additional investment. Does that make sense? You can't sell your own stock to yourself and have gains and losses. Does that make sense? The owners are the owners. Okay? So what we do, we say, all right, debit cash for whatever I got. What's 4,000 for 11 bucks? 4,400, right? Everybody good with that? That's what it is. Okay? But what do you want to credit treasury stock for? This account treasury stock. What do you want to credit treasury stock for? 4,000 at the 10 bucks you paid for them, right? How much is that? 4,000. So what's the $400? More additional paid-in capital. So here's another account. So there are a few equity accounts, not a lot of them, but a few. Additional paid-in capital, guess what cleverly we call this? Additional paid-in capital from the sale of treasury stock. Got the idea? It's from treasury stock. So that's another additional paid-in capital account we add, okay, to the equity section. Pretty simple, logical, okay? Now, this is something that's not in the book, okay? Pay attention to this one. Let's sell the other 6,000. And let's say the market value went down to $9 per share. Am I going to have an economic loss if I bought it for 10 and I sell it for 9? Yes. But will I record that as a loss on my income statement? No, because I'm doing business with myself, right? Okay? I must really like these new shareholders, I guess, is the idea. Because I'm willing to give them some of my retained earnings to get them. That's how this is going to be handled. Really, we don't know what to do with the other debit, so we plug it in retained earnings. That's really what's happening. Okay? How is this going to work? How much cash am I going to get? 6,000 at $9 is how much? 5,400. Don't look so excited, guys. It's nice to have an easy day. Okay? Good. Okay? treasury stock, I don't have it anymore, right? It's not an asset, right? It's contra equity, but it's gone now, isn't it? Okay? How much is left in that account? If you put, you know, you put, what did I do? You guys didn't even say anything. 4,400? You guys are more asleep than I am today. Did anybody notice that was wrong? Somebody knows. You guys, it's 4,000 shares at $11. How much is that? Yeah, 44,000. Come on. Okay, 44,000 sound better? Okay, and then what do we pay for them? $10 a share on 4,000? Something like that, 400. So that's 40,000, right? And what would the additional paid in capital? 4,000. Thanks a lot, you guys. Okay, anyway, did that make sense? A little more sense? Okay, good. All right. So what do we sell them for now? 6,000 at 9 is how much? 54,000. Okay, there we go. All right, and what would we take out of treasury stock? If you put 100 in, right, and then you took 40 out, what's left in there? 60. What are you going to have to take out if you sell them all? 60, of course, right? Just cost method is what we got there. Okay, what am I going to debit? Now let's say this was the only transaction we ever had on treasury stock. What's the balance in additional paid in capital? 4,000. So what's the most you could debit it for? 4,000. I mean, you can't have a debit balance in additional paid in capital. What would it mean, right? So you can only go to 0. So that's the rationale for this. Additional paid in capital on treasury stock would go down to nothing, right? And I need another $2,000 debit. What do I have to go to? I don't know where to put it. It's an economic loss, but I don't want to record a loss, so what do? I go to retained earnings. That's simpler one. And it's kind of intuitive, isn't it? It makes sense to do it that way. Now you got treasury stock. Probably give you a problem that looks like this. Okay? So it's test file. Easy. See where treasury stock comes from. Okay. Now let's see. So we've done a stock split. We've done treasury stock. Okay. We've done issuing the stock in the first place, which is pretty simple. Remind me next time we'll do preferred and common dividend and splitting them with different types of stock. We'll get into what preferred stock's about. Preferred stock's not really preferred. It's just the name of it. Usually it doesn't have the right to vote. Do you think that's preferred? Common shareholders vote. Preferred shareholders don't. I think common is better, right? But preferred shareholders get a dividend before common shareholders get one. That's a preference, right? In liquidation, but preferred shareholders are limited to the dividend that they have typically, right? Whatever it states on it. $100 par value, you get a 4% dividend, you get $4 a share, and that's all. What if there's additional dividends that become through a profit? That all goes to common shareholders. If they're taking more of the risk, they get more of the returns, the idea. Anyway, we'll get into all that stuff next time, okay? But what I want to do now is maybe we'll do stock dividends. I did stock split, let's do stock dividends, okay? And well, first let's do cash dividends. I guess we ought to do that. You already know how to do cash dividends, don't you? What's the journal entry? Let's say there's going to be $100,000. They pay the dividend. What would it be? They pay it. Go ahead and pay the dividend. $100,000 dividend. What are you going to credit? Cash, of course. We've been doing this all along, haven't we? Debit what? Retained earnings. Or if you want, you can use a temporary equity account named dividends and then close that to retained earnings, right? End of the year. So we already knew this, didn't we? Okay, now we're going to add a little more complexity to that. Not much. We are going to have a date of declaration. Okay. Date of declaration. A date of record. And a date of payment. Make sense? Why do you have these? Let's say I have 3,000 or 3 million shareholders. I got a lot of shareholders, right? I don't know who owns the stock. I can find out, of course, if they're registered owners, but I don't know who to write checks to. So on the date of declaration, the board of directors votes to do a dividend. So let's say that happens December 1st, right? Okay, they vote to declare a dividend for $100,000. On the record date, let's say that's December 15th, we figure out who we're going to write the checks to. Not kidding. Find out who owns the stock. Okay. Then at December 30th, say, let's say December 30th, we actually pay the dividend, right? Write the checks and send them out. We have the time in between those dates then to figure out who we're going to write the check to and get the check written up, and then we send it on December 30th. Got the idea? So it facilitates doing this, okay? So what kind of entries are we going to have on each of these days? Oh, by the way, if she owns the stock and she's going to sell it to me, if she sells it to me before the record date, I'm going to get the dividend. So I'll have to pay her more because you already know there's going to be a dividend. Let's say it's $2 a share. You know you're going to get $2 a share on the 15th. If you sell me the stock between December 1st and December 15th, what do you bet you charge me more for it? Because I'm going to get the dividend, right? But if you sell it to me on the 16th, or even the 15th, anytime after the 15th, she's going to still get the dividend even though I own the stock, right? Because they're going to look at who owns it on the date of record. So then I'll pay her less for the stock, of course, unless I'm a crazy person, right? Okay? I'm going to pay her for a dividend I'm not going to get. Got the idea? So when you look in the Wall Street Journal, you look on Yahoo Finance or something online, they'll be next to the stock price, it'll say X dividend. What do they mean? Without the dividend. They already declared, they already had the record date of the dividend. That's what that means. Is that good to know? Well, yeah, if you're investing in stock, it's kind of good to know if you get the dividend or not, right? Because it'll be all over the newspaper, right? The business section, so-and-so's paying the dividend. If you buy the stock, oh, it's too late, you're not going to get the dividend. Get the idea? If it's earlier, you're going to get it. So, anyway, so it's $100,000. What would you do on the declaration date? You know you owe the dividend, so what would you do?
Liability.
Yeah. What do you want to call it? Dividends payable in the future. Yeah, really clever. This accountants, clever folks. Credit dividend payable, of course, just like any other current liability, and debit what? Retained earnings. Or if you want, you can use cash dividends account, something like that. You can call it cash dividends or dividends. Or you call it common stock cash dividends. I don't care. Preferred stock cash dividends. Okay? Got it? So that's that one. What would you do on the record date? You're just finding out who you're going to write the checks to. What do? No entry. You're going to tell me no entry. This is a fun chapter. You just envision points generating tension. You're bothered to study this stuff a little bit. Payment date. That I pay it. What do you want to do? Yeah, get rid of the dividend payable, you're paying it off, just like account payable or rent payable or something, doesn't matter. And credit? Yeah, ta-da. Everybody good with that? So there's a cash dividend, big deal. All right. Stock dividends. What is that? Well, really what happens is we don't have any cash, but we still want to give a dividend to our shareholders. So we give shares of stock instead. Now there's some debate over whether or not this really makes any difference whatsoever. Do the assets of the company change because you give this dividend? No. Do the liabilities change? No. So does the worth of the equity change, the value of the equity change? No. And now there are more shares, so what do you think will happen to the value of the stock? Good. Almost always. But there's a little bit of evidence that sometimes if the dividend is small enough, the shareholders actually come out ahead. When you take the number of shares they now have times the new market price, it's higher than that was before. Their investment actually goes up by virtue of doing this, okay? Some evidence of that. But sometimes it happens. But more importantly, probably, is a lot of companies have a policy of paying so much dividend per quarter. Maybe it's $1 per share per quarter, so $4 a year. So if you give stock dividends and they keep paying the dollar dividend, what happens? You get more dollars in dividends from them. That's all. Maybe there's some benefit there. Okay. Personally, I don't care too much about dividend policy anymore. Some people do, some don't. There are dividend stocks, and then there are growth stocks. Growth stocks are obviously what? You don't pay a dividend, you reinvest the money in the business instead. What I prefer, because you can buy and sell stock all you want, right? You can sell your stock and get cash out. Let's say you wanted to take your money and pay for your kids to go to college years from now, right? Well, you can either have dividend stock that's going to pay dividends to pay for the college tuition, or you can just sell stock, right, and pay the college tuition. What difference does it make? It's still cash, right? So it really doesn't make very much difference in my view, and there's debate about this, what dividend policy in the company is, okay? But some companies just pay dividends, and they always have, and they think that's a message that they're stable. General Motors was real good for this. They were paying dividends even when they were losing a lot of money. I thought it was kind of silly. They're losing money and you're paying dividends. What I want people to do is if they have a better way to use the money, they have something to invest in that's going to generate more profit for me in the future than I could do by investing myself, I'd rather they keep the money and not pay me a dividend. What do I have to do if they pay me a dividend and I'm not retired? Take the money and buy a new car for my wife. No. All right. What do we do? If they give you the money, we reinvest it in something else anyway. Right? Retirement, right? In your investments. Okay. So it doesn't make much difference. But anyway, companies do these stock dividends, and it's fine. Okay. So here's the deal with the stock dividend. There are two types. You just have to kind of remember this, but it makes some sense too. Two sizes, right? One is small and one is large. You read the chapter, you'll see that. Small and large. Big and little. How big is small? How big is large?
25%.
Yeah, this is 20 to 25% rule of thumb. The less than. It's a rule of thumb. Judge it, right? This is more than. I think that's way too big enough. Because you know what I think happens? I think if you issue a 5% dividend, you're going to get the market value of the stock to change a lot. But the idea here is, supposedly, when it's small, the market value does not change, or at least not very much. We're going to record them at market value. That's the thing you have to remember. Here, we're going to record them at par or stated value. So let's say that we have 1 million shares issued and outstanding, okay? And let's say there's no treasury stock in other words. By the way, are you going to give a dividend, cash dividend or stock dividend to yourself? All the unissued shares, are you going to give a dividend on the unissued shares? Of course not. You have to be giving dividend to yourself, cash or stock. So in the treasury stock, you're not going to either, right? Because you're holding those shares. So in the unissued shares you're holding, you're not going to give yourself a dividend, right? And the same with the treasury stock. So it's only going to be on the outstanding shares. Got the idea, guys? Outstanding shares. All right, anyway, so I'll make them really obvious. This one's going to be a 5% dividend. I will include some tests too. This is going to be a 30% dividend. We're almost done. This is only going to take a second. How do you record this? You pretend that you gave them a cash dividend and then they bought the stock, okay? I'm giving them stock instead of cash. So I'm still going to do what? With any cash dividend, what would I debit, everybody? What do you debit when you do a cash dividend? Retained earnings, yeah. So it's still retained earnings. And then you can debit a stock dividend if you want, or just dividends if you want, and close that to retained earnings, okay? And you are going to credit common stock or preferred stock. It's a preferred dividend, although we don't usually do that. Okay? On the large, it's the same thing. Retained earnings, stock dividend, common stock. But there's a difference. On the small one, we're assuming the stock value is not going to go down. So let's say our par is $1, okay? Get the idea? And our market value is $10 per share. Okay. The large one's a simple one. Let's do the large. How many shares are you going to do? There are 1 million shares outstanding. We're going to have 30% dividend. How many shares do? 300,000 shares. Everybody agree on that? What's the par value? $1. We're going to record it at par. Debit retained earnings for how much? 300,000 times $1. Okay. It's that simple. Credit common stock for how much? 300,000. How much additional paid in capital is there if you issue them at par? None. Right? Okay. Now let's do the small one. It's harder. 5% of 1,000,000 shares. How many is that? 50,000 shares? But what are we going to issue them at? Because it's a small dividend and we think the market price is not going to go down. We're probably wrong. That many shares going out there. But $10, right? So we take it times the $10 market value. Got the idea? How much is that? How much is the debit retainer? $500,000, right, guys? 50,000 at $10. What's the par value of those, though? It's $1 par, guys. What's 50,000 times $1? 50,000. Oh, what's the amount that got paid in excess of par? Remember, we're pretending we gave them the cash. We gave them the $500,000, and now they're buying the stock. The way you can think about this. Okay, got the idea? So what's the 450,000? It's $9 a share on 50,000 shares, right? Market value is more than the par. So what's that going to do? Additional paid in capital on stock, just like we had issued shares or cash or something, cash, land, building, equipment, or something. Okay, gang. Not too bad, huh? There was one thing I did not mention and should have when we were back messing with the treasury stuff. Why would people buy this treasury stuff? Why would you buy back your own stock? A couple reasons. Let's say you think your stock is selling for too low a price, the market just doesn't notice. Jesus, makes no sense. We know our stock is worth more than that, and they're not buying it for that higher price. What could we do? Start buying it ourselves. See if the market notices and drives the price up. Does that work? Occasionally. There's some limited evidence it works once a month. Usually it does nothing. Okay. What's another reason? I've accumulated a whole bunch of cash in my business. We don't know what to do with it. We either pay a dividend, but then we'd give all our shareholders that cash. Or what we could do is we could decide to buy out a bunch of the shareholders. And also maybe drive up the stock price, right? So we could buy out shareholders. So the majority shareholders could buy up the minority shareholders, got the idea? And solidify their percentage control. That's another reason. Another one is that he's a shareholder and he is driving us crazy. We're top management and he just, he calls, comes by and wants to analyze everything and he says, geez, go away. We just offer him some money. Give him a good price for his stock. We buy his stock. We buy treasury stock. What do the other shareholders think of that if we gave them too much money? And the management of the company, officers of the company are giving him their money, right? Remember, you're using your shareholders' money. Okay, that was not too bad, but kind of bad, in my view. Another one is called green mail. There's a hostile takeover going on. So the SEC rules, Securities and Exchange Commission you read about in Chapter 5, right? SEC rules require that if you buy so many shares of stock, a certain percentage of the stock, you have to notify the SEC that you're doing that. And the reason is because you're taking over control of the company. You're getting a big enough chunk that you're going to help run this company now, right? So they have to let the existing shareholders know this is happening. Because if you're buying the stock out in the stock market, right? And you buy it and buy it and buy it and you accumulate your share. Okay, well what happens sometimes is this will be somebody who wants to take over the company and replace the management. Right? They think it's not being run very well. That's why they think the stock's a really good deal. So they buy the stock in chunks, right? And their intent is to fire all the management. So guess what the management will want to do? Buy them out, stop them from doing it. It's called a green belt. So they offer them a really good price. And there are these takeover artists, sharks they're called, right? That come in and they try to buy out companies that they think are underperforming, they say. And a lot of times what they're going to do is they're going to fire a bunch of people, close down operations, sell off their assets. It's not all positive stuff, right? But they're going to generate more wealth for themselves and for the remaining shareholders, right? That's their idea, okay? So they come in and they start doing this. Well, existing management, with the permission of their shareholders, of course, can offer them a lot of money to go away. But where does the money come from? The existing shareholders. Now, as somebody who's outside, right? So you could buy a treasury stock for that reason, right? So that's another place treasury stock comes from. As somebody who's outside, what would you think of that? Let's say you only owned a few shares of the stock. The Humana deal right now, right? We're trying to buy Humana out. Right now, there are 5 companies that have the vast majority of health insurance in the nation, policyholders, right? I'm one of them. I'm with Humana, Hugh Bellin. Everybody at Bellin is with Humana, right? Humana is one of them. It's one of our companies here in town. They're going to be bought up, maybe, right? The shareholders voted to go ahead with the deal. It's just whether the government's going to let it. Why would the government stop? There are 2 mergers going on right now among those 5 companies. There'll only be 3 left. And it's something 60 or 70% of the insurance policies in the country for health insurance. What if we get down to 1 company? Charge whatever they want, monopoly, right? That's what antitrust laws are for. So the federal government's going to have to decide whether or not they're going to allow this thing to go through. But there are thousands of insurance companies, by the way, that sell the rest of the insurance. There's just some really big ones. There's a huge ones. Humana's one of them. But anyway, what's the deal, though, if you're a shareholder? You own a few shares of the stock. Somebody's offering you a whole bunch of money for your stock. Wouldn't you rather just take the money, sell your stock? Probably. Why did Humana vote? Why did Humana shareholders vote to accept this offer? They want the money, right? And the upper management, Jones is about to retire anyway. He's an old guy, and so he's going to take his few billion dollars and retire, I suppose, or do something else. Okay. So, our hospital takeover is bad. This is not a hospital, of course. This is criminal. Right? They negotiated the price. Anyways, that's where the treasury stuff comes from. Okay, guys? See you. Have a good weekend. Do study, okay? Don't let up now. Don't let up now. You guys are the survivors. Give me some time this weekend. It'll pay off for you. I know you will anyway, right? It's a habit now. Besides, doesn't it feel